All right, this is one of Mr. Kavula's favorite things to harp on, so I'll invite him to chime in whenever he feels the need to get on the soapbox. One of the most important things that we do, again, and we talked about the diversification stuff a few minutes ago, one of the most important factors behind the success of what we do is to diversify by small, medium, and large. And you want to have some of each of them, all of the above. The general recommendation is to try to target so that your portfolio will be made up of 25% small companies, and get the Madden Cruiser going here, 25% large, okay, and then 50% in the middle or medium. And the way that we designate company size at Manifest Investing, a small company is that field of companies that are growing at greater than 12%. Large companies are those growing at 7% or less. So, and then everything in between is medium. So you want to split out into small, medium, and large. And here's just one more example of why you want to do that. Here's the Russell 1000 and the Russell 2000. Most of us are very familiar with the Russell 2000. That's a collection of 2,000 small cap or smaller companies. And you can see that that one is denoted by this red line up here at the top. The Russell 1000 is kind of like the S&P 500 plus the 500 next largest companies. So they're still all really pretty large companies. There might be a few mediums in there, but the Russell 1000 is basically a large company index. And again, notice that if you reach back 10 years ago, both of them were pretty much together right here back 10 years ago. Well, the Russell 1000 has not made a whole lot of progress in 10 years. Still sitting around zero, whereas the smaller companies are, again, chiming in or pitching in and doing their part of this mix with much better returns over that 10-year period. Now, the one thing that you might want to also notice with this graph, again, here's a really nasty bear market. We hate them. But this is actually quite a sizable drop here in the smaller companies. It's actually bigger than the blue one, believe it or not, on a percentage basis. So again, if you get into a situation where you have signs of a vulnerability to large bear markets or large corrections, you have to think about what that means with respect to small companies under those conditions, and maybe do some shifting around either into larger companies or certainly into higher quality companies, or perhaps even holding a little bit more cash under those conditions. But in general, that's why we do the size diversification. That's why you want to have 10 to 12% average overall sales growth in your portfolio. Any questions or comments on that?
No, we're still pretty clear, Mark. A hand just went up. Gene's hand is up. Gene, you're unmuted.
Mark, when you have a large company, at least based on market cap or based on sales or revenue, as NAIC does, as you know, sometimes at 12% you can end up with a Cisco or something in there. Can you not on occasion?
No, Cisco as in the food company, or?
No, the tech company. I've looked at a couple of them lately, and I've seen where some of the larger ones measured by sales or revenues have a growth rate of sales growth of bigger than 12%. And but they're really larger cap companies.
Yeah. What you're describing, and no, in case you're wondering, Ken, I didn't put Gene up to that question. What you're describing is some of the exceptions that you can see, and for me, there's a whole lot of exceptions. In the case you just cited one, Cisco, that's definitely a very, very, very large company by their annual sales. I think we all agree on that, right? By the same token, I haven't looked lately, but Cisco could easily have a growth rate in the 10% range. And the point is, in its field of opportunity, in the market that it serves, it's still a relatively small company. You know, Microsoft, when it hit 30 billion in sales, or I'm just picking a number out of the air, was still a relatively small company as determined by their growth prospects. And that's why we make the distinction. And I can give you the other side of the coin. We used to talk about the company that makes swimming pools that has the ticker symbol POOL. This was a, you know, at the time we did the case study, it was a $250 million per year company. You look at that using annual revenues and say, wow, that's a tiny company. And then somebody tells you, well, nationwide there's only, 400 million sales in swimming pools every year. They have, virtually the lion's share of the market. Well, by that token, they're an extremely large company. You look at it a little bit closer, and again, this goes back a few years, but at the time, their growth rate was something like 4%. So again, you had a $200 million company with a 4% growth rate. Is that a large company or a small company? And again, for the purposes of what is the design intent of that company within your portfolio, it really comes back to it has to deliver the growth, sales growth. So again, it comes back to the company and its specific market and its field of opportunity and its true growth potential in the real world. So that's why we basically focus in pretty much exclusively on the sales growth forecast as the real measure of company size. Okay, let's keep going. Again, as you're doing your studies, what's important. We stipulate that you really want to be focused in on these three primary characteristics. Your return expectations, by the way, that's what sets us apart from most of the investing world. That's why most of us are incrementally more successful than the quote-unquote average investor, because we develop and monitor these expectations of return. That's what sets our community apart. Quality, we've already talked about it. Quality will protect you in bear markets and recessions. Make sure that it's a part of your shopping. You want to shop for the best. We'll talk more about that in a minute. And again, growth. And one of the things I like to use as a way to conceptualize or wrap our arms around this one is that's a picture of our son back when he was a freshman or a high school football player. And at the time, I think he was like 5'10" and maybe 160. And we had a contest in a class, actually, where we said how big, how tall, and how much do you think Alex will weigh? And again, it's just to make the point that you can think of companies kind of like children as they grow and they become mature and stop growing, and they become even more mature like me and they grow in undesirable ways. But you can actually think about growth characteristics and life cycle and compare it in some ways to human characteristics. And again, just our reminder here, put all those three things together and answer that question. Buy it, hold it for as long as it makes sense to do so. Here's one of our favorite things to do in the community, and when you're shopping for a company, let's say you went out and you were thinking about possibly investing in Sherwin-Williams. Just walked by a bunch of paint cans just yesterday, and I did a quick study on Sherwin-Williams, and you found, well, prices, the projected return is pretty average, high quality company, but you can come back to the chemical specialty chemical industry, sort the industry snapshot by quality, and literally I think most of us in the room want to shop at this end of the sort. I didn't even keep the weaker companies on the snapshot here. We would do most of our shopping at the top of that list, and again, we would probably be shopping for here's the goods. These are good quality companies. Here's an interesting return. It's a company that I've always been impressed by in the environmental field, Landec. And then this one here that I added to the round table portfolio last month because of its relatively high returns. This is a very high quality specialty chemical company out of the Indianapolis area. So again, Hawkins, and the reason that I feel good about it is it seems to be on sale, and it's towards the top end of the higher quality companies within this particular industry. So again, one of Nicholson's greater gifts to us was invest in the best. So again, for relatively new investment clubs, this will keep you out of trouble more times than not. Make sure that you're shopping amongst the best companies within industries or peer groups. Let's talk about this notion of, well, when are we ready for more, whatever that is, whether it's quote-unquote more advanced investing or whatever. And he actually gave us a definition for this too, the Nicholson number. Literally, it amounts to taking a look at the annual contribution to the investment clubs, dividing by the total assets of the club, and checking to see if it's less than 10%. In the case of tonight's club, Northern Traders, as you heard Lori say, they've got 9 people kicking in about $25 a month, 12 months per year. Their current assets are just under $5,000, so you can see, again, as a relatively new club, this number is quite a bit above 10%. So again, the only thing they should be thinking about on the planet in the world of investing is finding high-quality companies that are on sale. They shouldn't really worry about anything else at this point in the life cycle of the investment club. But as the years go by and the assets accumulate, you begin taking care of a larger portfolio when this number starts to happen. And again, for the average investment club, this is going to be in the 5 to 6 year range on average. This is when it's time to kick in and think about it. Is there some other stuff that we should be doing? Or all those absolute rules and maxims that you've heard over the years, like never invest in a PE above 20, or you guys have all heard the rules, don't do this ever. And most of those statements are really intended to protect beginning investors that have a Nicholson number less than 10. I happen to be in an investment club where our Nicholson number was 0.0, I think 0.0015%. So yeah, it was a big club, and most of our time really should have been spent on taking care of the portfolio, capital preservation, and all that kind of stuff. So once your investment club reaches that zone, you really should be reaching and grabbing for more. So again, I would just urge everybody out there, take a napkin out, figure out what your Nicholson number is. What do we mean by going beyond core? And it's something that we are exploring fairly carefully at Manifest. It could mean retaining a whole lot more cash than you're normally comfortable with. Again, for beginning investment clubs, we basically say stay fully invested. Once you've been doing this for a few years, staying fully invested isn't a very good idea at all times. And in fact, Nicholson, if he were here, he wrote a column where he almost used the word stupid. He almost used the word stupid. If you've really got experience as an investor, let's say your investment club is 10 or 15 years old, and you're 100% invested, fully invested in common stocks at all times, you're probably suffering more pain than you need to. There are opportunities to improve your performance if you just reach and try to understand them. And that included things which he referred to as investing in general market securities. And I know some of you just got the shivers. This includes companies that would be classified as non-growth. Could even be that, a company like Colgate-Palmolive, for instance, where some people don't see a lot of growth, non-growth. Could even be a cyclical company like a railroad or some type of an energy company, or even a special situation where you have a company with a limited operating history or a potential turnaround, maybe a brand new management team that you really have a lot of faith in. There are some areas that you can, with experience, take advantage of, and then some other protective measures. But one of the things that Nicholson was crystal clear on, you don't have to do this. He basically said, take 75% of your portfolio, call it your core portfolio, keep doing the same thing, and take 25% and do this non-core type stuff, this general market security stuff. You don't do it with the whole thing. And he was crystal clear on this. You don't have to do it with that other 25 or 50% of the portfolio. That's your choice. But I find that it's a really interesting area to learn, and even more important than that, I really see a great potential for incrementally higher returns, using all the same concepts and philosophies that we deploy, in discovering and building out that core portfolio. Same concepts, and again, potential for incremental returns, just doing some slightly more innovative or a little bit different stuff. Never stop learning. So with that, I think we'll go ahead and just point out that I do think that successful long-term investing, our parent organization, the investment club movement, that umbrella organization, they do an awfully great job of showing us a wonderful set of training wheels. It's okay to kick off the training wheels when you're ready to do so, and when your Nicholson number gets down to 10 or less. And we'll just kind of leave it at that.